If you have an existing mortgage that's locked in with a financial institution and you decide to move, what happens? Do you have to pay it out and pay a penalty? Not necessarily. A very popular option is to be able to port the mortgage, short for portability. When you port a mortgage, you take it with you to a new property. So you sell your existing property, buy a new one, and take your mortgage with you. Now, a common misunderstanding, though, with that is that a new application is not required. No, a new application is required. It really is a brand new mortgage, but you're keeping your existing rate and you are not paying a penalty on it. But a new application is still required. But what happens if you require a different amount of funds? What happens if you require new funds or less? Well, if you require less, then the new property costs less and you require a smaller mortgage, you can pay it out subject to your prepayment privileges, and there'll be a penalty over and above that. But if there's a new amount, so if you require more funding, you can do a port add-on. So you port your existing mortgage, you keep your existing rate, but you add funds to it. When you do that, we have to blend the two rates, which is just a weighted average, which you will have learned in grade school and we will have reviewed in FINS 150. But let's take a look at an example. So let's say I have a client who's moving. Their existing mortgage is $270,000. The new house that they're moving to is a bit more expensive, so they figure they're going to need 30 grand in new funds. Their existing rate is 5%. They have 2.25 years remaining, and you have some new rates there. So first thing we need to do is we need to determine how much of a total mortgage they're going to require. So they got the 270 existing, 30,000 new. They're going to need 300,000. Then we need to determine what proportion of the mortgage's existing funds and what proportion is new funds. So 270 out of 300, or 90% of it is existing funds. 30,000 over 300,000, or 10% of it is new funds. Each of those is going to be at the appropriate rate. So the existing funds are going to be at 5%. The new fund, so which of the rates are we going to choose? We're going to choose the one that is closest. So 2.25 years. So we're going to round that down to 2 years and we're going to take 2.5%. And we are going to multiply that out. So we get 4.5 and 0.25 for 0.75% is the rate for the overall mortgage. Effectively, it is the same thing as if they were paying 5% on $270,000 and 2.5% on $30,000, but we blend it together to make it easier for the customer. Only one payment, only one interest rate.